Hello everyone, I am Srinivas Rao Ravuri, CIO Equities at PGIM India Mutual Fund. And there is increased volatility and nervousness in equity markets in recent times. Let me take you through what is driving this and what is the way forward. Broadly, we can explain this in three parts: global issues, Indian macro, and stock markets. And let me start with global issues. We are living in an uncertain world, and unfortunately, there seems to be no end to this, as trade tension between US-China have now escalated to US and Europe also. There is a concern about possible recession in the US. Middle East region continues to experience one-off incidents. Overall, global growth is slowing down, and this has implications on many issues, including pressure on exports from India. Fortunately, we are not so much dependent on exports. In fact, we are a net importer of commodities and would benefit from softer prices. Our main worry is possible increase in crude oil prices, as we spend almost $110 billion every year to meet our 85% of oil requirements. Fortunately, crude oil prices are benign. Also, increased duties on Chinese goods is an opportunity for India as our product becomes more competitive. We are seeing early signs of some benefits from this trend. So coming to Indian macro issues, though the government has been talking about accelerating economic growth and articulated its aspiration to be a $5 trillion economy by the year 2024, something was amiss, as GDP growth in the June quarter was one of the lowest in recent times. There was a slowdown in investments and there is a slowdown in consumption as well. Over the last few weeks, there is a dramatic shift in government approach towards corporate India and to revive the economy. The sharp reduction in corporate taxes is a big move by the government. Many experts have rightly called this as the biggest and boldest reform in many years. Typically, governments tend to go for such bold reforms when there is a crisis. Though there is a marked slowdown in the economy, it can't be termed as a crisis. So full credit to government for initiating such bold move. More importantly, it looks like we are at the beginning of next phase of much needed reforms. We need to privatize PSUs, restructure loss-making PSUs, and accelerate spend on infrastructure. Government has initiated move to privatize 5 PSUs, including BPCL and Container Corporation. This is a very good beginning. One can expect an acceleration in foreign direct investments into the country and revival of capex cycle. In fact, 15% corporate tax rate has already started attracting many foreign companies across sectors like auto and chemicals. So this is a good move to take care of investment cycle. However, it does not solve immediate problems related to the slowdown in consumption demand and liquidity issues in the market. So government and RBI are actively working towards lower interest rate regime to revive the economy. This, along with good monsoons and increased spend by government, would lead to revival of economic growth in the coming months. So to improve liquidity in the system, the government is not just spending more, but wants to clear all dues to its vendors and incentivize private sector to spend more. Government still needs to do more to revive the demand and consumption in the economy, and one can expect more initiatives aimed at this in the coming weeks. Key challenges are slippage in fiscal deficit, as tax revenues are muted and expenditure remains higher. Second is crisis in NBFC sector. This will continue to have its ripple effects across various sectors. This brings me to the third part: what does it mean to stock markets? Corporate India is likely to report weak numbers in second quarter and not so great numbers in third quarter as well. However, one of the golden rules of investing in equities is stock markets are about tomorrow, not today. While the near-term outlook for the Indian economy and corporate India is challenging, there is every reason to believe that outlook would change for better in the coming quarters and years. Looking at the current per capita GDP and demographics, India is a growth story for next 1-2 decades, not a few years. However, one should lower return expectations from equities as interest rates and inflation are trending down. But equities remain as the most attractive asset class. We believe in India growth story and positioned our funds accordingly to deliver superior risk-adjusted returns. We continue to focus on high-quality companies with visible earnings and trading at reasonable valuations. We are positive on sectors like pharma, industrials, and utilities, and underweight on sectors like auto and FMCG. Though large cap index Nifty 50 has delivered 4% return in 1 year, 15% returns in 2 years, and 30% returns in 3 years, Nifty Small Cap 100 Index has delivered negative returns of 12%, minus 28 and minus 13% during the same period. This explains investor anxiety. Post this correction, we believe there are opportunities across large, mid and multi-cap funds depending on investors' risk appetite and time horizon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.